Welcome to Aon's Insights Series, everyone. And today's session, A Perfect Storm, the Rise of Supply Chain Risk. I'm Rob Cusack. I'm a director of Aon Global Risk Consulting, and I head up a market-leading consulting team, which specialises in working with organisations to understand the nature and extent of their supply chain exposures and make informed decisions and to better manage supply chain risk. And joining me today to shine a light on this important topic from one of Australia's leading energy retailers is Jonathan Dent. Jonathan's Group Manager with Insurance at Origin Energy. Jonathan will be able to provide us with an insider's perspective on how supply chain risk is viewed and managed within one of Australia's leading organisations. Also joining us today is Sarah Walpole, who is Aon's Placement Director. Sarah works at the coalface with local and international insurance markets to help secure insurance solutions required to protect corporate balance sheets from supply chain risk exposures. Global supply chains have been redefined with increased risk and turbulent change, and thus disruption is now characteristic of many supply chains across the regions and industries. Security of supply, delays in logistics, schedule impact, and price risk are common. There is a pressing need for companies to actively manage risk and cost, logistics, and many other complex variables related to global supply. Successful companies have a clear global sourcing strategic intent and execution focus. Companies that make solid supply choices gain advantages and de-risk their supply chains. Local content priorities and considerations must be integral to all global procurement planning to bring balance across the entire spend profile. ESG objectives like combating modern slavery and pursuing environmental goals must also now be integrated into global supply planning and execution. And recent major events such as the looming gas crisis in the UK, the COVID-19 pandemic, Brexit, trade sanctions imposed by China, the Suez Canal blockage, have all highlighted the dramatic social and economic impact caused by compromised supply chains across the world. The insurance market has historically played a role in protecting balance sheets from certain supply chain risk exposures. However, at a time of greatest need, this appetite has diminished somewhat, creating a perfect storm, further exposing businesses at a time when they have never required more protection. Supply chain risk exposures have largely been covered from a perspective of protecting business from contingent business interruption exposures, which arise from damage to property, say of key customers or key suppliers. In this session, we'll be exploring how supply chain risks are viewed, understood and managed in leading corporations, and what insurance solutions are available to risk managers to help address this exposure, and why insurance markets are reducing insurance solutions at this time of need, and how organisations can better position themselves to actually secure better balance sheet protection. So having outlined today's theme, I'd like to bring in Jonathan into the conversation to bring corporate Australia's perspective. So Jonathan, energy security is both a commercial and political imperative. As Australia's leading energy retailer, how important is the issue of supply chain risk to Origin, and how does Origin manage this risk?
So thanks, Rob, and good morning, everybody. Perhaps I'll set the scene a little bit with who Origin are. So yeah, Origin is an energy company here in Australia. We're both a wholesaler and a retailer of energy, which means we produce energy primarily through our fleet of power stations, and we sell electricity and gas to around 4 million customers. Like all companies, we have a purpose, which we define as getting energy right, and that's in the context of what's right for customers, what's right for communities in which we operate, and what's right from the impact we have on the environment as a whole. So our challenge in supplying affordable and reliable energy in a really challenging energy market, and that challenge is both a political one and sadly sound, reasonable, rational, bipartisan energy policy has avoided us in this country for probably about 4 prime ministers now. But it's also as a result of sustained low wholesale electricity prices. And that's been driven by a significant increase in renewable generation entering into the market, which is competing against a fleet of ageing it's still operating coal-fired baseload generation. So Origin currently generates about 2/3 of the electricity that we sell, and that gives us a physical hedge to, to high spikes in wholesale prices. Sadly, not that we're seeing that at the moment, but hopefully there's a hot summer ahead and everyone will be running their air conditioners at full tilt. And with respect to gas, Origin has a significant reliance on contingent third-party supply. So from an energy security perspective, gas is vitally important. And we see it as that transitional fuel as we bridge the gap between thermal coal exiting and renewables coming the more dominant energy supply source. As you just touched on, Rob, gas is really challenging at the moment. It's a really volatile market. Natural gas prices are at record highs at the moment. And one of the reasons for that simply is, Australia has enjoyed low gas prices for a long sustained period of time, primarily because we're just simply a domestic gas market. But with the rise of LNG production, that's created one of the largest export industries in this country, and now we're competing for gas on a global scale. The other challenge is an obvious one. It's expensive. It's expensive to explore, and it's expensive ultimately to reduce natural gas. Origin has an opportunity in the Northern Territory of Australia, and that will be hundreds of millions of dollars in exploration costs, and pretty much billions of dollars of expenditure to get that to a commercial operation. And of course, we need to consider all these issues with a sharp ESG lens as well, acknowledging this is becoming increasingly important to our shareholders, investors, and of course, insurance companies. So yeah, Origin, we purchase large volumes of domestic gas, and that strategy has exposed us to material supply chain risk. And this extends to things like pipeline disruption, production risk, insufficient supply risk, unplanned outages, which is especially relevant for gas infrastructure, which, is aging in this country. And put simply, any break in that chain has a material flow-on impact to us. So we've spent a lot of time with our business units and with Aon, to better understand this supply chain exposure. For us, it has layers of complexity. Supply chain risk has an impact or could have an impact on a specific site or a specific customer. Or it has a wider impact to the portfolio of gas demand that we're required to supply. So what we do is we look to model real-world scenarios, consider what impact a major disruption would have on our business, but also the broader market as well. So each year we review, we test and model all sorts of different scenarios to really try and understand that exposure and the mitigants that we have in place in the event that there's a major supply chain disruption. And this gives us a deeper understanding of the risk and the impact that ultimately supply chain disruption would have. I'll be honest, can we obtain adequate insurance cover? Probably not in every scenario. But I think the analysis that we do with Aon, and what we've undertaken to make, pretty much more informed decisions, what this does, it gives us greater flexibility, to modify coverage, look at the increased limits, look at decreasing limits, look at particular sub-limits, whether we can trade off deductibles, those types of strategies. And this has been a real advantage for us over the last few renewals as we look to alleviate the impact of a hard market cycle. And ultimately, that's driven pretty positive premium outcomes as well.
Following on from that, Jonathan, we know that energy companies are facing unprecedented change at an ever-increasing pace in the race to transition the business towards a clean energy future. The rapid innovation of new technologies will involve brand new supply chains that are not clearly understood. How is Origin approaching this new challenge to managing supply chain risk?
Yeah, so it's for Rob, it's probably really important to understand what this energy transition will look like and how quickly it will happen. So we think you'll see rapid decarbonisation. And when I say rapid, I'm talking in an energy context, so over the next decade, basically. So as we know, as we exit from fossil fuels and we ultimately move towards a net zero emission world. So climate change receives the headlines, and that is certainly a driver, but economics is also a major driver of that as well. Baseload power generation, it's a bit of a misunderstood term in my view. It's in simplistic terms, it's just the cheapest and most abundant energy supply source. And this has been coal for a long period of time, and that's why coal is always attached to baseload. But that's quickly transitioning away to renewables. In the middle of the day now, coal simply can't compete with renewables. It costs us more to run our coal-fired power stations in the middle of the day than we're receiving on a wholesale market price. So you've probably heard of this term, the electrification of everything. And we believe that's what you'll see in this transition. And in many ways, that's the quickest way to a net zero world. And that's the way to move away from the transition from a reliance on historical fossil fuels. And I really say that, in a domestic day-to-day context. So, your vehicle will be electric sooner than you think. Your old gas heater will be changed by reverse cycle air conditioning. Your lawnmower will probably have a battery in it. You'll have solar panels on your roof. You'll have less reliance on the grid. You'll probably become a net producer rather than a consumer of power in the future. And I think to support that transition, what you'll see is this dramatic rise in things like large-scale battery and hydrogen opportunities being pursued. So these other technologies are sort of nothing new, but what is new will be the scale on which they'll be developed. So to give you maybe just a quick example, Origin's looking to install a 700 megawatt battery north of Sydney. That's huge. That's 7 times the size of the Tesla big battery in South Australia that was installed a few years ago. And the procurement, the design, the delivery, the installation of this project creates all sorts of supply chain exposures. There's a limited number of suppliers and contractors in that space. It's really competitive. With limited supply and limited ability to negotiate favourable contracting terms. We're often at a bit of a geographical disadvantage here in the Southern Hemisphere compared to some of our competitors in the Northern Hemisphere. Technology is still being proven and developed. What will be constructed on site, what will be prefabricated and shipped, how sensitive this new technology will be to shipping, and of course the availability of skilled staff, we think will be another real issue from a supply chain perspective. If I just touch on hydrogen, that's often described as the holy grail of energy security perhaps, but it's it's expensive and it's complex. It's likely to be developed in our view. I mentioned before a little bit about politics. It's one of the few technologies that actually seemingly has bipartisan political support. It'll likely be green hydrogen, so that's hydrogen that's produced by renewables. And I was going to say we probably see parallels with our LNG export business. But the addition of renewable energy into the sort of risk profile, that creates supply chain exposures perhaps not yet considered. I.e., how do you address the exposures of large-scale export projects against the intermittent nature of renewable energy supply? So we're speaking to our broker, insurance partners, on how we manage this emerging risk, and I'll be honest, I expect that continue to evolve for many weeks and months to come.
And just a final follow-up question then, Jonathan. Well, we've all been touched by COVID-19 and we understand the incredible impact that's had on us all. Can you tell us what additional challenges the current COVID-19 pandemic has presented to your management of supply chain risk?
Yeah, so like everybody, when the pandemic started, we had to mobilise something like 5,000 staff. And they all went home, really, but for the essential site teams that were working on some of our 24-hour facilities. So this included call centre personnel, our energy traders, our remote operating teams, which is a really impressive logistical and IT exercise. I don't think I knew what our IT team used to do, but we certainly know what they do now. It's perhaps stating the obvious, but specific to supply chain, we saw material extended lead time for critical items, specialised infrastructure. We need highly trained specialised staff, and the ability to get at skilled contractors has been a real challenge for us. And I sort of say that in the context of planned regular maintenance outages, but obviously that risk is really amplified tenfold in the event of an unforeseen planned outage. That said, we're an essential service, so thankfully we have a lot of government support, and that's definitely helped. We're an exporter of LNG via our joint venture in the Australia Pacific LNG project, and the pandemic created shipping quarantine challenges, but generally speaking, they haven't been too disruptive. Our export LNG business is primarily to China and Japan, which creates a level of geopolitical supply risk. But thankfully for us, having a Chinese partner as both a customer and a shareholder certainly mitigated that exposure. So I'd say COVID has definitely had an impact, but probably certainly not to the extent we've witnessed in other industries like travel and aviation and hospitality. But the one thing we've had to accept is sort of irrespective of the magnitude of the exposure, the risks are becoming increasingly uninsurable. And I'm sure it's probably not lost on this audience that almost all the insurers that we're dealing with are really trying to limit that exposure to sort of pandemic-related supply chains. But I'm more than happy to let probably Sarah expand on that challenge.
And Sarah, I might turn to you now to really get your market insights into the transfer of that supply chain risk, following up from Jonathan's overview. And how can the insurance industry assist to transfer supply chain risk, and how do the market's appetite to cover this risk evolved over time?
Yeah, hi Rob, and thanks for inviting me to participate. I think it's a really interesting topic and certainly very topical right now. JD gave us some great insights there into the risks faced by some of our clients and buyers around from a client's perspective on supply chain risk. And I think when we look at the insurance industry and the ability to transfer that risk, it's important to recognise that cover is certainly available. As you said, it's certainly contracting as well, but it is available, and it might be available through different product lines, for example, marine cargo or cyber, or in fact an ISR policy. So when we look at the ISR policies, we're talking about cover for physical damage, loss, destruction, and business interruption, so the interference of the company as a result of that damage. Now, in Australia, that's typically covered under an all-risk policy. So by its very nature, if a peril isn't specifically excluded, then by default it is covered. Now with that, there has always been that ability to reduce that cover and exclude certain types of perils or exposures. But I think certainly as these risks have evolved, as has the nature of the capacity providers to look to whether it's appropriate for that cover to indeed be continue to be covered under an ISR. So that might come really as a consequence of a couple of different impacts. And if we look at why, we can really look at awareness of emerging risks, such as cyber, which has come a long way, and certainly in the last 10 years, where technology has evolved so much, that risk has become much more apparent. Or it might be as a result of something currently happening in the world, and more of an awareness of that and the potential losses that come from that. So when we look at COVID and pandemic and the exclusion of that. So it's really important to acknowledge that there is cover available, but I think the question really is how appropriate is it for those types of cover to continue to be covered under an ISR policy, and do they in fact belong in a more bespoke solution where we can look to provide more appropriate cover that is more extensive and subsequently rated for and accounted for.
And then following on from this, Sarah, what are the current challenges for insurers, and how are they looking to reduce their exposure?
So I think, as you've already alluded to, Rob, and as Jonathan has pointed out, we're definitely living in a more volatile world, economically, geopolitically, and demographically. And with that volatility comes a lot of increased risk. Now, that risk isn't just the burden of it, isn't solely on the insurance industry. We've heard Jonathan talking about potential for the buyers themselves to take on some of that risk. And indeed, the government as well could potentially look to step in. Scott Morrison recently alluded to some of these heightened risks in a recent debate around supply chain risk, COVID, and the need for the government maybe to step in and really cited them as some of the world's most pressing challenges. So as global concern grows, and the pressure on the insurance industry to respond with a solution grows with it. Now, from our perspective here in Australia, we're in the fourth year of remediation, and we're certainly seeing consecutive rate increases within the ISR space. So if this cover is to continue under ISR, I think there is certainly a demand for better information. And if we look at how insurers are looking to reduce that cover, we can really look at three different ways. So firstly, they may continue to provide the cover, the sublimits requested, but with that, there certainly is going to be more knowledge needed in order to do that. Secondly is a contraction of the cover. So by imposing sublimits, whether they be reduced monetary limits or an annual aggregate applied, so that the exposure is quantified under the underwriter's portfolio. We've seen this particularly in respect of non-damage business interruption, where aggregates are certainly being imposed. And then lastly, a complete exclusion of cover. So pandemic risk, human infectious disease, and silent cyber are now, for the most part, outright exclusions under ISR policies.
And so, Sarah, given the current challenges you've identified in securing that coverage, how can insurers better position themselves to attract whatever insurance capital is available?
So, Rob, I think really the solution starts with innovation and gathering of information and a rethinking of access to capital. I think that we really need to encourage our buyers to better position themselves to go into the market. And as at Aon, we can certainly assist them to do that. The identification and mapping of supply chain risks is definitely becoming more of a demand, just to even consider the risk. I think that really comes into three different stages of the process. So firstly, we need to identify what the risk is, and by that I mean who, what, where. So Jonathan's already spoken about the supply of gas or essential services or skilled contractors. You know, are they globally available, or are they more of a local source? All of which can help reduce the impact of that supply chain disruption. Next, looking at the justification. So why is it supply chain risk? And really what plans do you have in place in order to mitigate that risk? So there we can look at BCP plans, ESG policies, and we've really seen through the pandemic that those with robust policies definitely were more resilient during the pandemic and were able to operate more efficiently and avoid maybe some of the disruptions of other customers. And then lastly, quantification. And at Aon, we're really able to assist with that through our Aon Global Risk Consulting team, with the quantification being put in a monetary number onto the exposure, so that we then can take that to market and present it and hopefully obtain the adequate limits for it. And I think that analysis can really engage the insurers much more. And we've seen that with additional information, we can certainly seek better cover for our clients. At Aon, we really do believe that better informed means better advised, which leads to better decisions. And we're certainly looking to engage more thoroughly with our buyers and with the insurers, so that we can seek those better solutions.
Yeah. Well, thanks for those valuable insights from both the corporate and insurance market perspective. I'd just like to share some insights really from Aon Global Risk Consulting's perspective. Having engaged with quality organisations like Origin on this issue across the globe, I can confirm that the securing appropriate supply chain coverage is a common issue across all regions and geographies. Losses have highlighted shortcomings in coverage limits, policy wordings, and a general lack of flexibility to adapt to the changes in client supply chains. something which is compounded by the fact that really risk managers are generally only advised of material changes at the last moment. And things can get very complicated when looking at supply chain, as it affects both marine cargo and property markets as well. Whatever the solution is, it needs to cover both markets. Wet markets don't like anything dry and vice versa. And as we've heard from Sarah, insurers are reducing their coverage and tightening their terms, reducing limits and requiring significantly more information across all industries and geographies. So the need to better understand the risk being underwritten has increased significantly, and more sophisticated risk managers are being proactive in responding with a higher standard and quality of the information. And so to support our clients, Aon is engaging with carriers at a global level and clients at a regional level. Carriers to understand what matters to them and to help build a globally consistent approach and to work with Aon and its clients. And the clients to ensure that we're developing client-centric solutions to meet their needs, not just now, but also into the future. So AGRC works closely with clients to obtain a depth of understanding required to make informed decisions surrounding the management and treatment of supply chain risk from an insurance perspective. And also leveraging our deep claim experience and data analytic capability, we're able to develop an auditable approach to assist our clients in terms of risk mapping to help understand the nature of the risk, risk quantification to understand the extent of that risk, risk management to establish the optimum balance between risk retention and transfer, to identify alternative strategies to manage supply chain risk where insurance solutions are not yet available. We also work quite extensively in collating and communicating the information required to attract the limited insurance capital to transfer that supply chain risk where it's intended. So that good information has direct correlation with limits that can be achieved. And also early engagement is really essential. We start working with clients 9 months before renewal to actually provide that depth of understanding. And most clients really have all the information required at hand and can find it difficult to obtain such due to the lack of visibility below the immediate suppliers. So in terms of their suppliers, of their suppliers, and difficulty in asking suppliers for information. So through the use of data and analytics, we are often able to help fill in some of these gaps in understanding, across all tiers of the supply chain. So there are certain must-have data points, the name of the supplier or customer to be insured, but the addresses of the manufacturing locations or the key distribution warehouses. So not just the actual address of the head office of the supplier, for which contingent business interruption coverage is granted. So they're the must-haves, but then there are further soft points that actually go to a really more in-depth understanding. That's really risk quality and management standards set for suppliers, linking back to business continuity and disaster recovery planning. What supply chain risk management structure is in place to enable the early detection and implementation of mitigation strategies to reduce the overall impact of any disruption. COPE information and secondary modifiers, such as the addresses where the actual supply comes from. The potential impact, in actually understanding what impact would flow from damage. Information on the mitigation protections at those sites. Available supply capacity versus utilisation, dependency on logistics, alternative products, availability and price. These are all soft factors that are used to determine business resilience, through the potential to employ these loss mitigation strategies. It really can highlight a point of differentiation between yourself and your actual peers. So Aon's next evolution to support clients tackle the supply chain risk is to extend the proposition to non-property damage risks. So really building a consistent approach to the assessment and quantification and driving increased appetite for and alternate forms of capital to finance the risks of our clients. So Aon's ambition is to move towards an all-risk supply chain risk financing product supported by consulting and analytics. And whilst this is our ultimate ambition, we continue to work with organisations like Jonathan's to optimise current insurance solutions and provide a better balance sheet protection. So hopefully today has been useful to shine a light on this important topic of managing supply chain risk exposure in today's volatile environment, and really how Aon can actually help work with both carriers and clients alike to better understand and manage and insure this risk. So in closing, I'd just like to thank all of you that have joined us here today, and especially Jonathan and Sarah for sharing their valuable insights into this important topic. Good day.
Thanks, Rob.